Funds and ETFs are hugely important asset classes. So what's special about funds and ETFs, which stands for exchange traded funds? So they're both different types of funds. Funds are important because they pool lots of investments behind one security. You buy one security just like buying one share, but behind it there could be a big pool of other investments, shares, bonds, you name it. And secondly, the funds allow you to diversify. If you buy shares in a company, all your risk is focused on that company. But when you buy a fund, behind it, your risk is split between all the investments that the fund makes. Let's look at some definitions. First of all, let's see what a fund is. A fund is an investment company. It pools money from different investors to invest in a mix of assets. This could be similar types of assets like shares, or it could be a mix of different types of assets. Funds are great because they offer diversification and professional management by experienced managers. There are many different types of funds that we'll talk about later. The valuation of funds is usually based on their net asset value or NAV. NAV is equal to fund's asset minus the fund's liabilities or debt. Let's look at a few fund types. There are mutual funds which can be open-ended, meaning that investors can buy or sell the shares of the fund daily at the NAV, and the fund can issue more shares if there are more investors who want to buy the shares. Then there are closed-ended mutual funds that issue a fixed number of shares that trade on the stock exchange, but the price of the fund units or shares is determined by demand and supply. Exchange-traded funds, or ETFs, are one of the most popular asset classes these days. They are very similar to mutual funds, but they trade on exchanges just like single shares. There can be equity ETFs that invest primarily in shares or indices. There can be bond ETFs that invest in bonds or bond indices, and commodity ETFs that invest in physical commodities like metals, oil, agricultural products, etc. There are other categories, but at this stage, let's just concentrate on these three. The next category are hedge funds. These are funds that use sophisticated and risky strategies to generate returns. They have very experienced and sophisticated managers, they use complex strategies, and they usually have a high minimum investment requirements. They're not always listed on the stock exchange. There are private equity funds. These are funds that invest in private companies, then try to improve the company's performance, and eventually sell the company for a profit. With private equity funds, you have to make an investment and wait 5 to 10 years before you get your money and profit back. There are venture capital funds or VC funds that invest mainly on investments in startups. Then there are buyout funds. Buyout funds are funds that buy mature, underperforming companies, improve their operations, and sell them at a profit. Real estate investment funds, or REITs, invest in and operate income-generating properties such as offices, apartments, hotels, shopping malls, hospitals, storage, and infrastructure, which can include mobile phone towers and data centers, for example. There are equity REITs that invest directly in properties, earn rents, and make capital gains from sales. And then there are mortgage REITs that invest in real estate debt and earn income from mortgage interest payments. There are index funds. Index funds are a type of mutual fund or ETF that passively tracks a specific market index like S&P 500 or the Nasdaq. They are popular because they are diversified and have low costs. Money market funds, or MMF, are a type of funds that invest in short-term, low-risk securities such as government bills, commercial paper, and certificates of deposit. They are low risk and liquid securities which are used for cash management. They're very popular, especially with companies that need to manage their cash and they don't want to go through the trouble of buying and selling lots of different types of assets. Then there are funds of funds, or FOFs. These funds invest in other investment funds rather than directly in stocks, bonds, or other securities. So it's a pool of other funds. This allows for further diversification, although it may come with higher fees because you have more management fees involved and it's a more complex structure. There are two general categories of funds that are very popular in the European Union. There are UCITS funds and SICAVs. UCITS stands for Undertakings for Collective Investment in Transferable Securities. They're the most recognized investment fund in the EU. They're designed to be very safe for retail or private investors and are subject to strict regulatory standards. SICAV stands for Société d'Investissement à Capital Variable. It is a safe and UCITS regulated investment company. They're widely used in Luxembourg and France. ETFs, which we've talked about before, are funds that trade on stock exchanges just like shares. They track the performance of a specific index, sector index, bond index, commodity, or other asset. They offer a way for investors to invest in many assets cheaply. ETFs are one of the most popular investment tools in the world. They are sector and thematic ETFs that invest in certain themes like electric vehicles, artificial intelligence, or sectors like pharmaceuticals or energy. There are many ETF providers. On this page, we show some of the largest global ETF providers based on the assets. Number one is BlackRock or iShares. Then you have Vanguard, that's also huge. Then you have the likes of State Street Global Advisors, Invesco, Charles Schwab, Lyxor, Amundi, etc. Please pause the video and have a quick look at these global ETF providers. Let's look at the largest European ETF providers. They start with iShares, which is BlackRock. Then you have Amundi, Lyxor, DWS, Xtrackers, and so on. Please pause the video and have a look at this table. To invest in ETFs, you need to understand the concept of the expense ratio. This is the annual fee that the ETF provider charges for the work they do. Usually, the expense ratio could be anywhere between 0.03% and 0.7%, but can go up to 1.5% or sometimes more. Not often, but sometimes. Please always check the expense ratio before you invest in an ETF. Remember also that when you buy or sell ETFs, just like shares, you have to pay the usual trading fees. Many popular ETFs have a currency hedged version, which allows the investor to buy the ETF in a different currency to the one it was originally issued in. So for example, if an ETF follows a list of US stocks, there could be a European version quoted in euro that is hedged on a daily basis to euros. There are some ETFs that have accumulation units that reinvest the income to buy more units. And there are distribution units that pay the income to investors. Usually, if the income is paid to the investors, that is viewed as income and is taxable. Accumulation units are not taxable in the same way, but obviously you would pay capital gains tax when you sell the units, and also the units that are bought can go down in price. ETF fees can vary a lot. There are low-cost ETFs such as index ETFs and broad market ETFs with expense ratios from 0.03% to 0.2%. They're usually passive and need little management. Often, the manager needs to buy a number of shares and simply sit on them. Then there are mid-cost ETFs that are sector, thematic, or active ETFs. They have expense ratios from 0.2% to 0.5%. They are more specialized or thematic, and when they're active, it means that every few months, the manager needs to swap some shares in and out of the ETF. So it takes more work, so it costs a bit more. Higher cost ETFs include niche, leveraged, or inverse ETFs. They have expense ratios of 0.5% to 1.5% or more. They focus on niche sectors or actively managed ETFs. Leveraged ETFs means that, for example, you buy an ETF on a share, and if the share goes up 10%, the ETF goes up 20%. Inverse ETFs mean that the ETF price goes in the opposite direction to the actual underlying share or index. So if the underlying index goes up by 20%, the value of the ETF goes down by 20%. Then there are emerging market ETFs. They have expense ratios from 0.25% to 0.75%. These fees are higher because it's more complicated to manage investments across different countries. If you've ever bought a share or a bond, you also need to know about ETFs.